Welcome to What I Say. This is episode 7 in the Fund and Gain series, The Road to Your Financial Future. Now let me start by reminding you that this whole series is about investing for your retirement, not about making you the next Warren Buffett or a star hedge fund manager. In episode 1, I introduced John Bogle's 4 factors: reward, risk, time, and cost. At least one episode was devoted to the first 3 factors. Cost is the only one not explicitly covered yet. And I said too that one of the key goals of the series was to help you formulate your own investment policy to govern your retirement investing. So in each episode, I tried to extract guidelines to serve as a basis for your policy formulation. And I want to quickly review previous episodes and to begin building a basic policy that can serve as a template for your own individual investment policy. And by the way, I don't think a policy has to be really elaborate. It has to be clear, and of course you have to follow it. Some foundation assumptions that underline the policy formulation bear repeating. I call these fund and gains principles. Number 1, it is not possible to beat the market. Most investors don't match the market. And your mission is to keep the market from beating you. Number 2, research shows that returns depend on asset allocation. In the beginning, you have to develop an asset allocation appropriate to your circumstances. Number 3, investing is risky and some losses are inevitable. Remember, you are investing for your retirement. You must protect yourself against catastrophic losses. Number 4, you cannot escape human emotions. Bubbles have been with us and will continue to occur. Vaccinate yourself for your own emotions through knowledge and self-discipline. It is clear that to get on the road to your financial future, you have to start by saving. Episode 3, Don't Miss the Starting Gun, was about one of Bogle's factors, time. It demonstrated that building an adequate retirement balance requires 30 to 40 years, virtually your entire working life. You need steady saving and investment of at least 8% of your income to create a reasonable expectation that you'll retire with sufficient retirement income to maintain the standard of living that you attained during your working life. The charts and graphs, savings and investment simulation in episode 5 clearly showed that the earlier you start saving and investing, the more your savings will earn over your investment lifetime. You can't get anywhere without saving. So number 1 policy item is save and invest 8% of your total family income. Bottom line, you can't spend everything you earn. I leave the details to you. Episode 2, O Fortuna, dealt with rewards, another of John Bogle's 4 factors and the one that you cannot control. Reward is Bogle's way of saying investment return. Remember, retirement investing is not about picking winners, it's about constructing an investment portfolio that will garner market returns and guard against catastrophic losses. Episode 6, The Ragged Rock, discussed another of John Bogle's factors, risk, and made the case for you that you should be very cognizant of your risk. As an investor, you need to control your risk exposure, and the means to control your risk exposure is through asset allocation. Retirement investors need to take into account their ability to recover losses over time, and this recovery ability diminishes as you approach your retirement. So you need to gauge and set your risk level based on your capacity for risk, namely your age and proximity to retirement, when setting your allocations. Throughout the series, I've talked about asset classes. In episode 4 and episode 5, I used historical data, return data, and standard deviation data to depict how returns vary over time and to look at behavior of simple portfolios constructed from 3 to 4 asset classes. The charts and graphs showed that in general, a diversified portfolio will have a lower standard deviation and will outperform most single asset classes over time. The conclusion was diversify your retirement assets through asset allocation. So your asset allocation will determine your potential rewards as well as your exposure to risk. And your asset allocation is the key to a successful journey to your financial future. Thus, policy item number 2, the fundamental investment policy is to develop an asset allocation that diversifies across appropriate asset classes. This is the heart of your retirement investment process, so I'll spend more time elaborating on this. There are several subordinate, I'll call them elements. Number 1 is asset classes include U.S. stocks, large cap and small cap, foreign developed market stocks, emerging market stocks, corporate bonds, TIPS, that's Treasury inflation protected securities, emerging market bonds, real estate investment trust, cash in the form of money market funds. And you'll have to decide the basic asset classes to include. Use mutual funds, index funds where possible as the building blocks for each asset class. Number 3, always include some portion of bonds in your allocation. Number 4, proportion the asset classes to adjust the overall investment level risk. And this is an important element. And number 5, rebalance regularly. Yearly is appropriate. Rebalancing is very important. It keeps the asset allocation constant. A real example is always helpful. So I show a sample allocation on the screen. In this case, I used 8 asset classes. And I had to abbreviate, so large US large cap is USLC, small cap is USSC, IEQ is international stock, EMEQ is emerging market stock, USIB is investment grade bonds, TIPS are US Treasury inflation protected securities, REITs are real estate investment trusts, and STB is short-term bonds. Each asset class is assigned a percentage, and of course they have to total 100%. And for this example, I've chosen allocation of 61% stocks, which is in the range of what seems to be a consensus among financial advisors for people who are in their early stage of their career. And you can also see the symbol for the Vanguard Index Fund for each class. Now the funds are what you actually buy to implement your allocation. So let me insert a footnote here. As a practical matter, the dollar value of the allocation to each class will be relatively small during the first few years of your investment program, so 4 asset classes might be more reasonable. Something like 45% US stocks, 20% international stocks, 25% US bonds, and 10% short-term bonds would be a good starting point. Now I know you just love charts and graphs, so I have to include some in this episode. And using 10 years of data from 2001 to 2010, I constructed a sample savings and investment simulation similar to the one at the end of episode 5. And it takes the sample allocation using the Vanguard funds, and so these are real results. It adds $4,000 at the beginning of each year to represent your contribution from savings. And at the end of 10 years, your $40,000 in contributions would have grown to $62,532. Now, for people who are older and further into their working lives, I show a more conservative allocation of 36% stocks and compare the returns for this profile, and I've labeled this allocation 2, and you can see it on your screen. Now, compare the average return and standard deviation with allocation 1. The much lower standard deviation, 0.12 versus 0.18, shows that you achieved a similar result with a lot less volatility. This is exactly what asset allocation is supposed to accomplish. The total value of your portfolio at the end of the 10-year period is $62,421, just $100 less than allocation 1. The 2008 meltdown had a lot to do with the poor overall performance of the 61% stock allocation. This is one of the few 10-year periods when bonds outperform stocks. But $100 difference in portfolio value, you might be saying, what difference does it make? What it says is that constructing an asset allocation yields benefits over a wide range. If you had invested only in large cap stocks during the period, you would have ended with a value of $52,636, basically $10,000 less than either allocation and just $12,000 more than you saved over the entire 10 years. So let me take a different perspective, that of those who are already retired. And this is important. Things work differently when you're retired. Instead of contributing to your portfolio, you are withdrawing funds to live on. So assume our model couple has just retired and has diligently saved and invested and accumulated $500,000 in financial assets. This will be our starting value. And let's assume further that they withdraw $25,000 annually from the portfolio for living expenses. This is kind of reverse from the savings simulation. Now look at the next chart. It compares the ending portfolio values for each year with allocation 1, which would be termed aggressive because of the relatively high allocation of 61% to stocks. The investor would see a portfolio value of $59,800 at the end of 10 years. With asset allocation 2, the value would have increased to $655,860. In the past 10 years, the lower risk allocation actually performed the higher risk allocation. What's up with that? Just remember that fortuna is fickle. Higher risk in no way guarantees a higher reward. And once again, be advised that the next 10 years will look different. But you can see that asset allocation makes a difference. It's not so likely that the next 10 years will be like the last 10 and that bonds will continue to outperform stock. You can be too conservative early in your investing lifetime, and you will need stocks in your portfolio. And a longer term perspective and some of John Bogle's common sense should help you set your allocation appropriately. Establishing a specific allocation is somewhat arbitrary, I think, and with regard to both the selected asset classes and the percentages for each class. It is more important to set your allocation and then stick to it. I compared just two possible asset allocations. You can set a very wide range of allocations, and you'll always be tempted to tweak your allocation in response to external influences. Resist the temptation to second guess yourself. At the same time, you do need to be prepared to make adjustments from time to time, and your policy should include a process for assessing changes to your allocation, especially as you age. Now, even as fascinating as these simulations are, I think I should move on to the next policy element. Element number 3 is establish a selection process. As I have noted, you can't buy asset classes per se. You have to buy mutual funds to implement your allocation. And that's really the only practical way to accomplish your objective, especially when you're just starting your investing. And many, if not most people, will invest via 401k plans, so you will have to buy mutual funds. And you should certainly take advantage of a 401k if your employer offers it. You will have to select from the mutual funds that your plan offers, and different funds have different risk-reward characteristics. And you need to create a process to choose the funds that are from the funds that are available to you, and thereby implement your asset allocation. And I again recommend that you use index funds as much as possible. Now, I showed asset class performance over longer periods of time in episode 5. Use historical data to analyze your fund choices and to see how each fund tracks and correlates with the asset class benchmarks. 3- and 5-year return data that you most often see is just not sufficient. Be prepared, for example, if you change employers. It is highly likely you will have to select from a new list of funds for your new 401k. And you'll also have an option to move assets in your old plan to an IRA rollover account and select a whole new roster of funds from what is most likely to be a much larger universe. As I said in episode 6, risk is a perception, and that can change. Human nature tends to ignore risk on the halcyon days, so it is especially important to include risk awareness and assessment in your policy. So policy element number 4 is make a specific risk evaluation for each change to your asset allocation or to your investment portfolio. Prepare your financial ship for the inevitable storm. 2008 was an example. You saw the benefit of better prepared asset allocation just now. Now, don't just look at recent returns. Always ask yourself what the risks are. Review each fund prospectus to remind yourself of possible poor outcomes. The larger your portfolio grows, the more you have to lose from a mistake. And remember, you are probably changing your risk exposure if you change your allocation. So let me repeat, gauge and set your risk level based on your capacity for risk, namely your age and proximity to retirement, when setting your asset allocations. This translates to higher bond allocations as you age. Heed the advice of seasoned investors who have proven themselves both on the halcyon day and in the sudden fury. Maintain a historical perspective. Expect some losses. Don't panic. It is important to analyze your portfolio performance, and I think it's a bad idea to watch your funds every day, but compare performance of your selected funds against benchmarks each year to confirm that the fund that you've selected still adheres to its benchmark and thereby represents the asset class that you intended in your portfolio. We all have a tendency to think that if portfolio values are going up, we are doing fine. Are your funds going up as much as they should? Contributions add to portfolio value but can mask underperformance. Down is bad, but down is also inevitable on occasion. Did your assets decline more or less than the benchmarks? Make this analysis part of your annual rebalancing effort. So policy element number 5, evaluate and monitor your funds using asset class benchmarks and historical data. This is it so far. Let me do a quick summary. There are 5 basic policy components developed thus far in the series. You can see a short version on your screen. Number 1, save 8% of family income. Use asset allocation. Have a process to select mutual funds and use index funds as much as possible to implement your allocation. Evaluate risk. Evaluate and monitor your retirement portfolio. Track your asset performance on a regular basis, and by that I mean annual. You will need to create policy details for each element. Write your policy down. Keep a notebook of your evaluations, decision criteria, and your actions. And before I close, I want to exhort you to learn. In the first episode, The Secret, I stated that the goal of the series is to help you invest for a secure retirement. Retirement investing, especially in the early days when you're just starting your career, is a do-it-yourself project. You're on your own. You need to develop your financial survival skills. And I referred to several financial investment luminaries: John Bogle, Burton Malkiel, Robert Shiller, Jeremy Siegel, David Swenson, Nicholas Taleb, and Benoit Mandelbrot. Now, these are serious investors and academics with long and distinguished records. I recommend that you take time to search out and read their books and articles. Learn how to use Excel if you don't already know how. Plenty of data is available. Develop your own analyses and models, and these will help you make better decisions, and it will inoculate you against excess emotion. So in closing, there are many further topics on the road to your financial future. I think, though, that if you're just starting your investing and you are faced with the prospect of choosing funds for your 401k plan, you can do very well with what we've covered thus far. And I'm not sure what the next episode will be, so I'm going to take a break.